Markets require more than prices to function. Beyond supply curves and profit signals, exchange depends on predictable behavior, shared norms, and institutional trust. A buyer must believe the seller will deliver. A lender must trust repayment. Contracts assume enforcement. Reputation matters. These are not economic variables in the narrow sense. They are social structures, moral expectations that reduce uncertainty and make coordination possible. Adam Smith understood this. His economic analysis was inseparable from his moral philosophy. He saw self-interest not as a replacement for ethics, but as operating within ethical constraints. Markets, in his view, functioned because participants internalized norms of fairness, honesty, and restraint. The invisible hand coordinated individual actions, but it relied on the visible hand of social expectation. What did Smith believe made markets function beyond profit, and why did later interpretations lose this integration? 18th century Scotland and the Scottish Enlightenment. Smith wrote during Scotland's Enlightenment, a period of intellectual ferment in Edinburgh and Glasgow. Philosophy, science, and commerce intersected. Thinkers debated human nature, social order, and economic development. David Hume, Francis Hutcheson, and others explored moral philosophy. What motivates human action? How do societies cohere? Commercial society emerging. Britain was transitioning from agrarian feudalism to commercial exchange. Trade networks expanded, urban markets grew, credit and contracts became essential. This shift raised new questions. Could commerce corrupt moral virtue? Or could it refine behavior through mutual dependence? The moral philosophy tradition. Smith held the chair of moral philosophy at the University of Glasgow. Moral philosophy was the dominant intellectual framework before economics existed as a separate discipline. Questions of justice, duty, sympathy, and virtue were central to understanding society. Commerce was not separate from ethics. It was analyzed through ethical categories. Why moral concerns mattered. Markets depended on informal enforcement, handshake agreements, reputational capital, honor among merchants. Legal institutions were developing but incomplete. Trust and social sanction filled the gaps where formal law could not reach. Smith observed that self-interest alone could not sustain complex exchange. Moral expectations provided stability. The institutional problems Smith addressed. How could decentralized exchange work at scale without constant conflict or exploitation? What norms guided behavior when formal oversight was weak? Could self-interest align with social benefit, and if so, under what conditions? Smith's answer began not with economics, but with a theory of human sympathy, the mechanism by which individuals moderated their conduct in light of others' judgment. The theory of moral sentiments, 1759, the foundation. Smith's first major work was not about markets. It was about moral psychology, how individuals make ethical judgments and regulate their behavior in society. Sympathy as social glue. Smith defined sympathy not as pity, but as the human capacity to imagine another's perspective. When observing others, individuals mentally place themselves in the other's situation and assess whether the emotion or action is proportionate. This mutual observation creates feedback. People adjust behavior to gain approval and avoid disapproval. Sympathy generates social coherence without requiring central authority. The impartial spectator. Smith introduced the concept of the impartial spectator, an internalized observer that individuals consult when making moral judgments. This inner figure represents generalized social expectation. It restrains excess and encourages moderation because individuals seek the spectator's approval. This self-regulation mechanism was critical. It meant ethics operated internally, not just through external enforcement. Reputation and self-command. In a commercial society, reputation became a form of capital. Merchants who acted dishonestly lost future business. Trustworthiness was economically valuable. Smith emphasized self-command, the ability to restrain immediate impulses for long-term social and economic benefit. Moral virtue aligned with economic success, but only because social structures rewarded consistent ethical behavior. The Wealth of Nations, 1776, economic coordination within moral framework. 17 years after Moral Sentiments, Smith published The Wealth of Nations, often read as a purely economic text, but grounded in the same moral infrastructure. Division of labor and specialization. Smith opened with the pin factory example. Specialization multiplies productivity. Division of labor was possible only in societies with stable exchange, predictable norms, enforceable contracts, and trust among strangers. Economic efficiency depended on institutional and moral preconditions. Self-interest within constraints. Smith's famous line, "It is not from the benevolence of the butcher, the brewer, or the baker that we expect our dinner, but from their regard to their own interest." This is often quoted to suggest pure self-interest drives markets. But Smith immediately contextualized, self-interest operates within social norms. The butcher's self-interest works because he seeks repeat customers. Reputation constrains opportunism. The brewer honors agreements because cheating would destroy his standing. Smith's argument was institutional, not purely individual. The invisible hand as coordination principle. The metaphor of the invisible hand appears only once in Wealth of Nations, briefly. It described how decentralized actions aggregate into unintended social benefit. But Smith never claimed this worked automatically or universally. It required property rights, enforcement mechanisms, stable currency, competitive markets, and moral restraint. The invisible hand was a coordination outcome, not a justification for unregulated behavior. Markets required character as much as competition. Smith emphasized that prudence, honesty, and justice were essential to commercial life. Without these virtues, markets degenerated into fraud and exploitation. Legal institutions could not monitor every transaction. Moral internalization filled the gap. Successful commerce depended on participants' commitment to fairness and mutual benefit. Smith saw no separation between ethics and economics. Moral sentiments explained how individuals developed ethical restraint. Wealth of Nations showed how that restraint enabled complex economic coordination. Key institutional insights. Markets function through layered mechanisms. Formal rules, informal norms, internalized ethics. Self-interest is productive when embedded in social institutions that reward honesty and punish deceit. Economic growth depends on trust infrastructure. Without it, transaction costs soar. Moral expectations reduce the need for constant surveillance or legal intervention. Over the 19th and 20th centuries, economic thinking increasingly separated from moral philosophy. Smith's integration was simplified. Wealth of Nations was excerpted. Moral sentiments was forgotten. Self-interest was reframed as the sole motivator. The moral preconditions Smith described were assumed away. Markets came to be seen as amoral mechanisms, efficient regardless of ethical context. This narrowing was not Smith's view. For him, the moral foundation was not optional, it was structural. Markets without moral norms were unstable, prone to collapse, and incapable of generating broad-based prosperity. Smith's system required both self-interest and moral restraint. Later interpretations collapsed this duality into simple self-interest alone. Smith's analysis revealed patterns that extend beyond 18th century Scotland. These patterns describe how markets function as social institutions, not isolated economic mechanisms. Pattern 1. Markets depend on trust infrastructure. Exchange at scale requires participants to believe commitments will be honored. Trust is built through reputation systems, repeated interaction, community oversight, legal enforcement, and moral internalization. Without trust, transaction costs rise. Contracts become complex, verification expensive, enforcement difficult. Smith observed that moral norms, honesty, fair dealing, respect for property, reduced these costs by making behavior predictable. Pattern 2. Moral norms reduce uncertainty. Economic decisions involve uncertainty about future actions. Will the seller deliver? Will the debtor repay? Formal contracts and laws provide some assurance, but they cannot cover every contingency. Shared moral expectations fill the gaps. Participants assume baseline ethical behavior. This assumption allows faster, cheaper transactions. Less time negotiating, less money on monitoring, more willingness to engage with strangers. Pattern 3. Institutional incentives shape behavior. Smith recognized that individual morality was influenced by institutional context. In competitive markets with reputational consequences, honesty becomes economically rational. In monopolistic or opaque systems, opportunism faces fewer costs. The structure of institutions, how they reward or punish behavior, determines whether moral norms are reinforced or eroded. Pattern 4. Self-interest operates within moral constraints. Smith never argued self-interest was unlimited or amoral. He assumed self-interest would be constrained by internalized ethics and social expectation. The impartial spectator concept explained how individuals internalized these constraints. When moral constraints weakened, through institutional breakdown or cultural shifts, self-interest could become destructive. Pattern 5. Decentralized coordination requires shared norms. The invisible hand metaphor described spontaneous coordination. Prices signal information, resources flow to productive uses. But coordination fails if participants act unpredictably or dishonestly. Shared norms create predictability. Buyers expect quality, sellers expect payment, both expect dispute resolution. These shared expectations are social constructs, maintained through moral education, community enforcement, and legal backup. Pattern 6. Virtue is economically productive. For Smith, virtues like prudence, honesty, and justice were not opposed to economic efficiency. They enabled it. A prudent individual saved, invested wisely, and avoided reckless speculation. An honest merchant built long-term customer relationships. A just society protected property rights and enforced contracts impartially. Virtue aligned with prosperity because it reduced conflict, waste, and uncertainty. Pattern 7. Moral decay undermines market function. Smith warned that as societies grew wealthier, moral standards could erode. Luxury, vanity, and short-term thinking could replace prudence and self-command. When moral norms weakened, markets became unstable. Fraud increased, trust declined, regulation became necessary. The breakdown of moral infrastructure raised costs and reduced efficiency. Markets required constant cultural maintenance. Smith's patterns describe markets as embedded in social fabric. Economic analysis cannot be separated from the moral and institutional context that makes exchange possible. Smith's integration of moral philosophy and political economy influenced later thinkers, though often selectively. 19th century political economy. John Stuart Mill and other classical economists acknowledged the importance of character and social institutions. Mill argued that markets required educated, self-disciplined participants, echoing Smith's emphasis on moral self-regulation. However, as economics professionalized, the moral dimension received less emphasis. Focus shifted toward formal modeling and mathematical precision. Institutional economics, early 20th century. Thinkers like Thorstein Veblen and John Commons revisited the idea that markets are socially embedded. Veblen critiqued the assumption of rational self-interest, emphasizing cultural norms and habits. Commons focused on legal and political institutions that structure economic behavior. Both drew implicitly on Smith's insight that markets depend on non-market institutions. Game theory and reputation models. Mid-20th century economists rediscovered the importance of repeated interaction and reputation. Game theory formalized how cooperation emerges in iterated exchanges. Agents honor commitments because defection damages future opportunities. This mathematical framework echoed Smith's earlier observation. Reputation constraints moderate self-interest. The moral language was removed, but the structural insight remained. Debates over market morality. Ongoing philosophical debates revisit Smith's central question. Do markets require moral foundations, or do they erode them? Some argue commercial societies cultivate virtues like honesty and cooperation. Others contend markets commodify relationships and weaken communal bonds. Smith's work remains a reference point in these discussions. He argued markets could reinforce moral norms if institutions were structured properly. Modern behavioral economics. Research on trust, fairness, and reciprocity revisits Smith's emphasis on moral sentiments. Experiments show people frequently act cooperatively, even when self-interest suggests defection. Behavioral economists attribute this to social norms and internalized ethics, concepts Smith explored 250 years earlier. The language is empirical rather than philosophical, but the pattern recognition aligns with Smith's framework. Smith's integration has been periodically rediscovered, reframed, and formalized. The core insight, markets are moral systems, resurfaces across intellectual traditions, though the vocabulary shifts. Adam Smith saw markets not as amoral machines, but as social institutions embedded in networks of trust, reputation, and moral expectation. Self-interest drove individual action, but it operated within constraints, internalized ethics, community oversight, legal enforcement. The invisible hand coordinated decentralized exchange, but only where visible moral norms created predictability and restraint. Smith's dual contribution, the theory of moral sentiments and the wealth of nations, was an integrated theory. Moral philosophy explained how individuals regulated conduct. Political economy showed how that regulation enabled complex coordination. Markets functioned efficiently not by eliminating morality, but by aligning self-interest with social norms that reduced conflict and uncertainty. Later interpretations narrowed this vision, separating economics from ethics and treating self-interest as sufficient explanation. But Smith's original insight remains structurally relevant. Markets depend on more than prices. They require trust infrastructure, shared norms, and participants who internalize expectations of fairness and honesty. For Adam Smith, markets worked best not when morality disappeared, but when it quietly endured, invisible yet essential, shaping behavior, reducing friction, and making prosperity possible across communities of strangers.